Hi guys, this is Dibyush Shah, a CPA and CMA faculty, and this video that we are recording right now is for one of the most complicated topics, easy for some, complicated for some others, ratio analysis, tested both on the CPA and CMA exams. So during the course of the next 1.5 hours, I will try to give you a brief insight on ratio analysis, purpose of ratio analysis, and three categories: liquidity, solvency, and operational efficiency ratios. I will also release videos on profitability and other ratios that will be in the next series of lessons. So hang on there. Let's start and go to the world of ratio analysis. Here, we will be primarily discussing three ratio analysis, that is liquidity ratios, solvency ratios, and operational efficiency ratios. If we look at the definition, what is ratio analysis? So ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statements. It basically says that it is a quantitative method. What do you mean by quantitative? That deals with numbers. It deals with numbers. It has some certain numerical values through which we can gain insight into what is the company's liquidity position right now or in the foreseeable future. What is the company's operational efficiency right now and in the foreseeable future, and profitability analysis. As the second line says, ratio analysis is a cornerstone of fundamental equity analysis. What is fundamental equity analysis? When you are making your own portfolio or you are devising whether you want to invest in this company or that company, ratio analysis is a very important tool. Not the only tool, but a very important tool when you are trying to find out the fundamental value of your equity investments or where to invest your money. What is the purpose of ratio analysis? First of all, ratio analysis allows you to compare across companies by eliminating the effect of numerical advantage and numerical disadvantage between companies. For example, TCS, a very big company, right? Market cap of more than $100 billion, revenue in billions of dollars. Mindtree, just coming up, growing company. You want to compare those two companies and find out which is more profitable as per your own analysis. How do you do that? Not possible, right? The numbers of TCS will be very high. Profits in billions of dollars. Book value per share is very high. Earnings per share is a ratio only, but revenue absolute figures will be very high. On the other hand, Mindtree is a growing company. Its numbers right now will be relatively quite less. How can you compare which is more efficient and which has the potential to make you more money in the future? You do that by a ratio analysis. Because when we are calculating ratios, we arrive at something ratio figure like current ratio, a very famous ratio, which is current assets by current liabilities. It is denominated in 2 times, 2:1. This is a comparable figure across companies, 2:1 or 2 times. But if you look at the numbers, current assets of TCS may be way more than Mindtree. not comparable. Second, ratio analysis also helps you to compare the company's internal performance. How the company is performing internally. Internally means whether it is making progress over the year. Is its earning per share ratio increasing over the years compared to what it was 5 years ago? This also helps you to compare within the company and across the company. Lot of confusion, right? English, lot of English, theoretical language. Let's look at actual sums and numbers. The accountant loves number, right? The accountant just love numbers. Let's look at numbers and trying to find out what I'm talking about. First is in this series of lessons, liquidity ratio. What is liquidity? Liquidity means cash. In our case, for an individual, when are we considered to have a high liquidity? When we have good amount of cash. For a company, liquidity means or liquidity ratios indicate the company's ability to meet its current liabilities. That means a company will be assumed to be sufficiently liquid if it has sufficient current assets to meet its current liabilities without going to the bank for borrowing or without having the need to raise money. Second, these ratios provide a very good indication. The company may have short-term liquidity problems in the near future. For example, just assume we are all individuals, right? Living on salary. My monthly salary is, say, 80,000 rupees. Convert that to dollars. 80,000 rupees. And my monthly expenditures every month on month is more than 1,50,000 rupees. What does it indicate? I have a money problem in hand. My monthly income is not sufficient to cover my monthly expenditures. What will I do? I will have to borrow money from somewhere, be it a bank, financial institution, or a friend, or a relative to bridge this deficit. When you are investing money in a company and you see that company has liquidity problems or is indicating that it may have liquidity problems in the near future, you may want to stay a little away from that company. Because if it is having liquidity problems, it will have to go to the bank to borrow money or issue debt, debentures, bonds, securities at interest to borrow money, on which it will be paying further interest. That will further eat into the profits. And I, as a stockholder, what I get is the ultimate profit after everyone has been paid, profit after taxes. So if you consider that, these ratios are very important, specifically for those companies which are seasonal industries. Seasonal industries means like umbrella. They have a seasonal demand and seasonal sale. So in the rainy season, they may have a huge amount of money required to produce the number of umbrellas. There is a very bad or very heavy monsoon. The sale of umbrellas will go skyrocketed up. And if it does not have sufficient cash in hand or sufficient arrangement with its creditors, how will it produce excess umbrellas? By borrowing money from bank, working capital arrangement, on which it will have to pay interest. That will eat into the profitability. And as a rational investor, see, all investors are assumed to be rational. Rational means they think of their own benefit and they have proper understanding of the financial state. A rational investor would like to stay away from a company that has liquidity problems now or perceivable in the near future. Before going to the liquidity ratios, we need to understand two concepts. Most of us commerce background students have read this from class 11 onwards. Current assets and current liabilities. What is current assets? Current assets are all those short-term assets of the company which are expected to be sold. That means inventory. Oblique realized. What is realized? Realized means you receive some cash, accounts receivable, or used as a result of standard business operations, prepaid expenses. Prepaid expenses. And cash is, of course, a current asset because it is the most liquid asset. What are current liabilities? Current liabilities are companies' short-term financial obligations that are due within the next year. Imagine I am standing today on 31st 12th 2021, finalizing the balance sheet. We know in US GAAP, they follow calendar year. So it's 31st December 2021. I am finalizing Apple's balance sheet. You guys will become CPAs or CMAs. You will deal with such companies. What will be your current assets? Those assets that you expect to be sold, inventory, realized accounts receivable, or used prepaid expenses over the next 12 months, that is till 31st December 2022, 1 year from the balance sheet date. What will be your current liabilities? All your short-term financial obligations that are due within the 31st December 2022, 1 year from your balance sheet date. This is the definition of current assets and current liabilities as per US GAAP and is consistent across IFRS. What are the general components of current assets? First is cash. Cash, of course, is a current asset, right? I can use it anytime to pay my operating or current liabilities. What is cash? It may be coin, currency, a note, amount in your bank account. In US, they call it checking account, savings account, whatever. That is your liquid cash. What is cash equivalent? Those highly liquid securities which are so near their maturity that they are free or they do not have any interest rate risk. US GAAP defines cash equivalents as those securities which have an original maturity of 90 days or less from the date of purchase. Now, what does this mean? Suppose US government issued a treasury bill. Treasury bill means US government issued its own security on which the US government will pay interest. That's the most safest form of financial assets you can hold because US government or Indian government will never default on their securities. So they issued it on 1st January 2021. The maturity period was 1 year, that is 1st of January 2022. Somebody who purchased it on 1st March 2021, for him or her, is it a cash equivalent for the company? No. Why? The original maturity is due more than 90 days from the purchase date. Does not matter when he is closing his books of accounts on 31st December 2021. When is this supposed to mature? Next day itself. But you cannot recognize it as cash equivalent because the criteria is original maturity on the date of purchase. But suppose the company sold it to me on 1st of November 2021. So for me, what is the original maturity from my date of purchase? November 30 days, December 31 days, 1 year of January, 62 days. For me, it is a cash equivalent. Remember the criteria, original maturity of 90 days or less, highly liquid investments. Highly liquid means they can easily be sold in the markets, share markets or bond markets, and have original maturity of 90 days or less from the date of purchase. Whoever purchased it, does not matter if it is a 10-year bill. If I purchased it today on 11th of June and it is going to mature within next 30 days, does not matter if it was issued 10 years ago by the government of India or government of US. For me, it is a cash equivalent because I am going to cash within 90 days. Third is accounts receivable. Accounts receivable is something when you are making credit sales in the ordinary course of your business. And that is why it involves no interest element, because normally you expect to realize accounts receivable within 90 or 120 days. So no interest is charged. Inventory, your inventory in hand, that is your current asset also, because you expect to sell it off, most of it in the next year, unless for those companies which have a long gestation period. For example, aviation. If an aviation company has 100 airplanes in its inventory for this year closing, it cannot generally expect to sell all the 100 airplanes. Then it will have to rationally categorize what is its current asset, how much it expects to sell in the next 12 months. Balance will be its non-current assets. Prepaid expenses. The best example is prepaid insurance. Now I will give you a very clear example. On 11th of June, today, suppose this is my closing year end, 11th of June, I paid 3 years insurance expense, health insurance in advance, 3 years. What is my current asset? My year ends on 10th of June, 2023. Let's assume today is my financial closing year end, 11 June, 2022. And I paid 3 years advance prepaid insurance. What will be my current asset? Only that is supposed to be utilized within the next 12 months. That is 10th of June 2023. So suppose I paid 30,000, 30,000, 30,000. 30,000 is my annual health insurance premium. I paid for 3 years in advance, 90,000. 30,000 will be my current asset today. Balance 60,000 will be non-current assets because they are not expected to be utilized in the next operating cycle, that is 1 year generally. Next, we deal with current liabilities. Current liabilities, as the name suggests, are those liabilities which are due in the next 1 year. Okay. First is your accounts payable, that is your creditors. They are all expected to be paid within the next 1 year, because when you purchase goods on credit from somebody, you generally purchase it on ordinary course of business. They don't charge any interest and they expect it to be realized within 90 or 120 days. Accrued expenses. What is accrued expenses? As per accrual accounting, those expenses, what does accrual accounting says? Income and expenses are matched to the period to which they are related to. For example, assume a company is there. Okay, any company. Its salary date is 4th of next month. So for 1st January to 31st January, its salary will be due on 4th of Feb. And that is the date on which it pays the salary. For 1st Feb to 28th Feb, it pays on 4th of March. And henceforward, now you are closing the books of accounts on 31st of December. For 1st December to 31st of December, the salary is going to be paid out in cash on 4th of Jan 2022. But as per accrual accounting, this is my expense for this period, December. So I'm going to book it in this period. How do I do it? What is the journal entry? Salary expense debit. This goes to your income statement. Profit and loss account, debit, expenses. Corresponding, you have to create a liability because this has not been paid yet. Salary expense payable. this will generally always be a current liability. Why? Because you expect to pay it within the next 10 days, 4 days. So these are those expenses which you expect to pay. Salary is paid in 4 days only, but accrued expenses which will be included in current liabilities are those expenses which you expect to pay within the next 12 months. Short-term loans. I borrowed from a friend 50,000 rupees. I promised to pay him after 2 months. It is less than 12 months. This is my short-term loan. I will include it as my current liabilities, current obligation. Unearned revenue. What is unearned revenue? The revenue for which cash has been received, but it is not yet earned. Suppose a landlord. I was a tenant. I am a landlord, okay? Assume, but I am actually a tenant. Let's assume I am a landlord for the example. I went to my tenant and I took 1 year rent in advance from him. I said, see, good, I am going into academics now, leaving my banking career behind. I may need some cash to run my house till this gets into order. I took 1 year rent in advance on 31st December 2021. Now, this rent relates to period of 1st January 2022 to 31st December 2022. My tenant was very good. He was staying on my house for a number of years. He had cash, he gave me the advance. Can I recognize it as my revenue on my income statement for 2021? No. Accrual concept. When does the rental income relates to? Next year, when the tenant will be actually utilizing that property. But I have received the cash. So what journal entry will I pass? Debit the receiver. I am the receiver. I have received cash. Cash account debit. What do I create? This is a liability. Why? Suppose 3 months later, the tenant came and said, COVID has again spread. There is again work from home. I am going back to my hometown for 3 years. I don't want to stay in your property anymore. 3 months rent I will be able to utilize in my income statement, but balance 9 months I will have to refund him. This is what is unearned revenue. I have received the cash, but I cannot recognize the revenue because I have received rent in advance or received cash in advance, and my revenue obligations are not satisfied yet. Until they are satisfied, this remains a liability, unearned revenue. So next year, once the January, suppose $15,000 or 15,000 rupees was the monthly rent. So for 1 year, I took 1,80,000. Once January passes, I will recognize 15,000. This is a liability. I will debit it to reduce it. 15,000 unearned revenue debit, revenue will be credited. This is how with every passing month, I will reduce my unearned revenue and it will become zero at the end of the next year. Just like prepaid expenses, you just reverse it. So you were paying rent in advance or insurance in advance. Think from the perspective of the company who is receiving cash in advance. Current portion of other long-term debts. What is this? This means suppose you have issued bonds, lot of bonds. Some portion of that is due next year. Interest or the principal amount, not the total bonds. That will be only included in your current liability. And other short-term debts, any other borrowing arrangements I made from bank or any other for less than 12 months. Once we have understood what is current assets and what is current liabilities, its liquidity ratios is now a walk in the park. Once you have understood what is current assets and current liabilities, liquidity ratio is just like a walk in the park. First, you understand what is working capital. Working capital is nothing. This measures the extent to which your current assets is more than your current liabilities. Nothing more. So the formula is very simple. Current assets minus current liabilities. We will use CA for current assets going forward and CL for current liabilities. This is an absolute dollar figure. For example, total current assets of the company, if it is $100 and total current liabilities is $60, working capital will be $100 minus $60, that is $40. Now, let's look at an example. Suppose for TCS, the figures are in billions. TCS had, on one side we have TCS, on one side we have Mindtree. Now TCS has a current asset of $27 billion. Mindtree has just $1 billion. New company growing up. TCS has a current liability of $18 billion. Mindtree 0.2, that is $200 million. Working capital, that is CA minus CL of TCS comes down to $9 billion. For Mindtree, it is 0.8, that is $800 million. Is this at all comparable? We read, right, that ratio analysis helps in comparison. Can you compare these two amounts? No. TCS is a well-established company, has established its name for so many years. And this is just a new going company coming in, not comparable. So working capital in actual sense is not even a proper ratio because it does not help in comparability. The working capital ratio is broken down to help in comparability. First ratio is current ratio. Current ratio says what are our current assets divided by what are our current liabilities. Same example. Current assets of the TCS are same. Current liabilities same. So current ratio CA by CL. For TCS, it comes down to 27 by 18. It's 1.5 times. I will tell you what is the interpretation. And for Mindtree, 1 by 0.20, it's 5 times. That means for every $1 of current liability, TCS has $1.5 in current assets. Sufficient liquidity, good liquidity, right? So it has $1 of current liability payable over the next 12 months. And it has, for every against $1, it has $1.5 of current assets. But let's look at the Mindtree. Mindtree suddenly 5 times means for every $1 of current liability, Mindtree has $5 in current assets, guys. So look, Mindtree is a far better liquid position than TCS. Once those billions were removed and it was compared to a ratio, which says simple, $1 of current liability, how much is the current asset? So we found out only $1.5 in TCS and $5 in Mindtree. Suddenly, through ratio analysis, I said, oh my God, Mindtree is very liquid. It is not going to have a liquidity problem at all. So as a banker, if I want to lend money, theoretically, I will like to give it to Mindtree. Because even if Mindtree current assets reduces sufficiently, it will still be able to, or as a creditor who wants to sell goods on credit. Theoretically, guys, theory, ratio analysis. This is not the only analysis used while interpreting whether to lend money or whether to sell goods on credit or whether to invest. One of the tools. Suddenly, I realized Mindtree is too much liquid. It can absorb a lot of shocks also, even if it is there. Let's look at the next page. Suppose COVID came. Let's go back to 2020. Suppose these figures were from 2020. COVID came. TCS had $27 billion in current assets. Right? 30% of its debtors refused to pay. They said, we are not in a position to pay you money. Or say 20%. No, 25% actually, sorry. 25% of its debtors refused to pay. And they said, we are not in a position to give you money right now. COVID has come, we are nearing bankruptcy. On the other hand, Mindtree has also had the same effect, 25% on its liabilities. Again, let's calculate the current ratio. See, TCS current ratio has come significantly down from 1.5 earlier. It came down to 1.125. That means now, when there was a sudden shock, economy had COVID, TCS had only $1. For every $1 of current liability, TCS had only $1.125 left of current assets. Whereas Mindtree still has $3 for every $1 of current liability. Same shock given to both of them. COVID came, 25% of their debtors refused to pay up. IT companies does not have much inventory either. See the difference. That is what the ratio analysis does. It strips or it removes the numerical advantage or disadvantage that any company might have and presents the number in a simple format for us to understand. This is what we were discussing in this slide. See. This eliminates the effects of numerical advantage. TCS had a huge numerical advantage. The effects got eliminated. First purpose. This is your second liquidity ratio. This says that let's take it further liquid. How do you take it further liquid? They say that let's include only those current assets which you can immediately liquidate to pay your current liabilities. So first of all, they exclude inventory and prepaid expenses from your current assets. Why inventory? You cannot liquidate your inventory in a very short period. If you want to liquidate your inventory today, you have only one method in the world. Put a 50% sale discount code or 60%, people will throng up, then you will incur losses. So this is an even more accurate measure. This tries to check your liquidity even on a further standard. It says forget about the current assets. Let's exclude inventory from it. You cannot liquidate in a very short time if any crisis comes. And prepaid expenses, that's not even an asset. I have paid cash in advance. That is just a book entry. Exclude that and divide that by current liability. From that, you get an acid test or quick ratio, which is even more liquid because it considers only your most liquid assets, that is cash, marketable securities, and AR. This is your liquidity ratio. They further said, some analysts, that current ratio is also not a very accurate figure. So we will go with quick ratio. Let's look at more analytical purpose. Those investors who are more risk averse, who don't want to invest or who don't want to lend money to any company which has any foreseeable crisis. They went and invented liquidity ratios and they use liquidity asset test ratios for it, not current ratio. They say inventory irrelevant. You cannot sell it in a very short period of time. Prepaid expenses, you can never sell it. Let's talk about your actual current assets, which you can immediately sell. One very fine example, Big Bazaar. When COVID came, it went bankrupt, had its store full of inventory. But that inventory could not be sold because of lockdowns. And apart from that, cash, marketable securities, and AR, it did not had. It went into bankruptcy. This is an important ratio, very important indicator. And it also says if you have a lot of inventory, your inventory might be obsolete. So with this, guys, this session, I have covered the liquidity ratios. In the next recording and in the next session, we will be discussing solvency ratio, in which solvency and your operational efficiency ratios. Hang on with me, guys. It will be uploaded right after this. Thank you, everyone. I hope you understood, guys.